Good evening. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. This video continues our discussion about closed-end funds and using that financial strategy towards retirement. If you want the full methodology and the 12 steps to financial freedom, then head over to Facebook and check out my group there called Navigate Your Finances. And I give you the whole thing. I will confess that I don't give you every single bulleted item with all the filler in between, but I do give you the framework and quite a lot of advice to follow. Reminders, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. Kind of the witching hour, cats are fed. We're all prepping for another fun day of work week and school week, and yeah, who knows? Cats are crazy. I'm not a financial advisor. I am a financial strategist, really just a strategist in general. I don't speak like the herd, and I don't want to be part of the herd. But I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So if I'm buying tomorrow, where would I invest? Before I answer, because I am going to answer, let's talk about some different stuff. Normally, I have this giant intro of why you should look into closed-end funds and what that gives you by investing in the closed-end funds. And I want to keep it a little simpler on this video. So if you think of where the talk show circuit gurus, supposed gurus, are pushing people to invest, they're pushing bonds and AI. NVIDIA just came out with record sales, but they pay a dividend less than Apple. Um, but if you're really looking to get into bonds and AI, that's where you should have been 6 to 9 or 9 to 12 months ago when prices were really low and nobody wanted to get into bonds or AI. But if you buy them now, you're just kind of buying into that greed market. Now, CNN's Fear Index, which is really the only thing I pay attention to at all on CNN, is a fairly decent metric for tracking the general consensus surrounding the market. It's a pendulum of sorts. It goes from extreme fear to extreme greed. I thought for sure, like we would have some type of event to kick us out of extreme greed, but lo and behold, we are still in extreme greed. And that just means you're paying more for stuff than you would normally, kind of like inflation. So where does that leave us? If you buy bonds and AI now, I mean, you can buy bonds, right? In general, you can buy AI, you can buy NVIDIA and pay an arm and a leg for it. But it's higher now. It's new money pumped into the market higher now than it was 6 to 9 to 12 months ago. So what if we got into some other areas? What if we looked in some different places? And I read an article from Brett Owens today, um, who runs the Contrarian Outlook, and he has some interesting advice. To do well in this market, look at closed-end funds. But he doesn't give the whole strategy, which I completely understand. He has his strategy, I have mine. Right? I guess we have ours, however you want to say that, but I have mine. But part of his strategy, so you look at closed-end funds, you also look at collecting rising rents. And I'm going to quote his article. His article says it's not the flashiest way to grow your wealth, but more Americans have become wealthy thanks to real estate than any other investment, which is weird. So the topic sentence, the first sentence of a paragraph under your heading, collect rising rent, is not investing into the stock market. I think that's a pretty telling sentence, and most people will just write it off. If you're looking to grow wealth, more people have become wealthy thanks to real estate than any other investment. Stock market, CDs, bonds, take your pick. Real estate has been better, but it's costly to get into real estate. You can find it cheap. There are ways you can get into real estate cheap, but it's honestly, it's a little harder for a married couple than a single person, but it's doable. So I find it strange that a stock market guru is inadvertently pushing real estate, and more strangely, or maybe more coincidentally, which I don't believe in coincidences, I talk about that form of wealth or that form of wealth building on my Navigate Your Finances page. And I just finished talking about how we bought our first property or our first investment property, looking to grow that portfolio and that side of our wealth building, wealth generating retirement plan and portfolio. So if you want that info, by all means, please come check me out on Facebook at Navigate Your Finances. As it pertains to Brett's article, I'll get back to it. So he talks about real estate, right? In fact, 7 out of every 10 American millionaires owe their wealth to the steady appreciation of property value. Unfortunately, most investors never venture beyond owning their own home. It takes a good chunk of change to get started in real estate, true and not true. And being a landlord can be a real headache, true and not true. But in the past few decades, Wall Street has created the real estate investment trust, and it's radically changed the work profit equation. This is Brett. By pooling a group of income producing properties and selling shares of the pie to small investors, it's opened the stakes, or it's opened an avenue to the high stakes world of commercial real estate. So in a real estate or a real estate investment trust, you can pay in with shares, right? And as their company collects rent, you get paid dividends. And he talks more about that, but I'll let him talk more about that as well. But as it pertains to us, real estate investment trust, real estate in general, it's a very good way, yes, to grow your wealth. And it's not going to be like poof, it happens overnight. Uh, there are advantages to real estate investment trust, and there are closed-end fund real estate investment trusts. There are also just closed-end funds who invest in real estate, and they might invest in a real estate investment trust or a specific community or Simon Properties that owns Simon Malls. There's lots of ways to get into real estate through a closed-end fund versus buying a single entity real estate faction. So I could buy Simon Properties, I could buy Wynn Resorts, I could buy U-Haul, I could buy what it's like whatever the other storage places are, uh, Pack Rat, whatever. Or I could buy a closed-end fund that owns all of that stuff. So the other metric he talks about is using hidden stocks, which we own a couple of those as well. They look pretty nondescript. Maybe they look flashy, maybe not. Most are kind of middle of the road nondescript, but they pay special bonuses or special dividends throughout the year. So Brett offers a different take than the talk show, which I like. And then you have to filter down to your specific strategy. And that's important. You have to know your strategy. I know ours. Do you know yours? Are you buying low and selling high? Are you dollar cost averaging your funds? Meaning, are you buying a fund now at 9 to buy the same fund later at 11? So now it's averaged to 10. Are you willing to buy higher than what you've already bought? Because you can dollar cost average. Most people look at that over a curve over time. But if you buy up here, I can't even see where my screen is right now. But if you buy up here, instead of doing this, you can choose to buy lower. So it drops your price every time you buy. Kind of depends on your strategy of dollar cost average. Are you investing for the short term? Are you building, or what are you building? What's your end goal? I've mentioned this quote for weeks. Warren Buffett says you want to buy stocks for 66 cents instead of a dollar. And you cannot do that in the regular market. You can do that in closed-end funds, but it matters how you use the advice. I actually need to do a meme video about some recent advice, but one of those talk show series is advising or recommending a buy-in to a specific closed-end fund that pays less than Apple, pays less than 0.5% a year, and only pays an annual dividend. It's like get into the AI trend with more than $30 a share for less than half a percent dividend and only get it once a year. If you're that desperate to get into AI, there are better ways than a single annual payment off a 35 plus investment. Um, but that comes down to strategy. Everybody's got their take. I've got my take, right? You have to know what your strategy is and what the best advice to follow is, or just how to filter all the different advice so you can apply it to your strategy. So our strategy, our goal is to supplement or fully fund our retirement through dividends and not the sell-off of our portfolio or not the sell-off of the principal balance. We don't use the 4% rule. We don't use the 60-40 stocks to bond system, right? Which means we don't really use any of the investment circle guru herd advice. It's great to know what they're saying, but we don't take any of their advice because it's bad advice. So it comes down to, are you willing to follow the herd and their single stock fool picks of what you should be buying now in greed mode? Or are you willing to break apart from the herd and do your own thing? I mean, either is neither wrong nor right. I have my opinion. You have yours, right? So you have to know your strategy. You have to be willing to buy into your own strategy. And then you have to know how you're going to react when all of these different people are pushing all of these different things. You've got to be able to filter all that stuff out and see if it really applies, like if it really makes sense. I'll be honest, I love Brett Owens and the Contrarian Outlook. It's the only service I pay for. But there are some articles that are like, man, this is not great advice. Like I get what he's saying, but it's not great advice. Or Michael Foster's his closed-end fund guru. And we I took Michael Foster's basic system and expanded on it for our strategy. But there are things that his crew of people say, and you'll read an article and be like, this is our strategy. And then maybe 4 articles later, it's like, but that's completely counter to the strategy you mentioned last month. Right? They're not perfect, but they're a lot better than the herd. And sometimes they mesh with our strategy and sometimes not. So on our cork board, on our strategical plan, it's use our strategy that I'll get to, unless you have a really good reason for breaking the strategy, which I'll also get to. We target monthly dividends unless we find an amazing deal on a quarterly player. We could look at bonds, right? Bonds are great if you can get them cheap, but bonds were the place to be 9 to 12 months ago. So targeting those are hard right now. It's possible, right? But whatever you find is also higher now than it used to be 9 to 12 months ago. So it's cheap in that it's discounted off its regular price, but it's also higher than where it was cost wise. Energy infrastructure is the same way. Oil, liquid natural gas, energy transfer, utilities. If you can get them cheap and discounted, amazing, right? But whatever they are now is generally higher than where they were a year ago because we're in that greed cycle. So if we look outside of the herd and we look at other areas, then our options grow. Now, the herd doesn't like oil, but the truth is, I don't know, 90% of our society functions because of oil. The laptop, the mouse, uh, your shoes are made with oil byproduct. You've got, I mean, the technology in a fridge, technology in a phone, pacemakers, crutches, there's so many oil byproducts, it's crazy. So to completely go no oil would drastically uh, it would slow the economy, but it would negatively impact our society. So oil we need, but picking it up strategically, picking it up at a great time is kind of hard to right now because everything's higher. Now it's on discount. There's one consistent uh, energy infrastructure fund that is on discount, but that discount window is closing, and it's also a lot higher than it's been the last 6 months, and we own it. So if we look outside of the general advice, if we look outside of bonds, if we look outside of oil, if we look outside of AI, right, our ability to pick out key areas and also pick out funds gets a little easier. So if we look at technology, but not as regards to semiconductors and outright AI, if we look at data management, cloud tech, there's some decent options there. There's one good option right off the top. If you've seen that new Matthew McConaughey commercial, right, and we're in the midst of the next technological revolution. Like you have ChatGPT and then Google's version and all this other stuff. We're going to see another boom in technology, and data is the new gold. So if you find that gold mine, you want to buy it discounted, which you can in a closed-end fund, but you also want to buy it super cheap. And that's really hard right now because technology in general is so popular. But it's doable. If you're looking at technology as a whole, Nvidia, Amazon, Microsoft, Google, ChatGPT, whoever runs that, right? All of that is higher than it was. Uh, our single closed-end fund focused on technology in the technological revolution is higher than it's been. But there's still a way to get into the uh, cloud management, the data management aspect of technology, because if we're going to grow technology like it has been, we need the management side of that. Uh, Other areas we can look at real estate. No one really knows how the market's going to go. Now, the market always looks forward. You need to be looking, and we need to be looking at least 5, if not 10, 20 years down the road, which is hard. And general market sentiment, yes, looks forward. But in the short run, no one really knows how it's going to go. We all have hopes. We all hope the Fed drops rates. And if the Fed drops rates, everything will do better. But real estate should take off. So real estate in this lull before we hope is the first cut in forever would be good. Convertibles, where if companies meet certain metrics, they can switch their stocks between stocks and bonds. That's good. You can also look at preferred shares. The talk show guys don't like talking about the slowing economy. They don't like talking about the possible advent of a recession. And they've already they've already redefined the words at least twice. We're in it. The economy is resilient, right? All this, however you want to say it, however you want to spin it. I watch Facebook Marketplace because I like old furniture and we like classic cars. There are so many classic cars, rare cars, cool cars, foreign import cars on Facebook right now under 15 grand. Okay. There are a lot of them under 5 grand. That hasn't happened in the last 4 years. It's crazy how many cars are on marketplace right now. And people are feeling this economy more than what the news wants to tell you. The economy is slowing, prices are going up, wages are stagnating, right? And if the Fed drops rates, it's going to skew everybody's vision. It's going to turn everybody's vision away from that data to where we focus on the lowered rates. So it's going to spur people into buying houses. We have, I don't know if we have a surplus of housing, but we have more houses on the market because people aren't willing to sell their 3 to 4% rate to buy a 6.5% rate. And people who are looking to buy that are currently renting can't afford a 6.5% rate. So if the Fed cuts rates, it's not going to be an uh, all out rush like it was at 4%. But a 6% rate is a huge difference from 6.5, 7, 7.5, 8. And if we focus on real estate, then all that other stuff seems to kind of go away. But you and I still know that inflation matters because the pricing at the grocery stores has not changed. It's still there. So prices are up, costs are up, right? And the housing market can be great. We would that helps everybody, right? But that still doesn't mean that core inflation number actually matters. So as we move into this slowing economy, preferred shares, preferred dividends pay before common stock dividends. So if the economy truly does slow and we hit a recession, right, which Facebook Marketplace is a non-scientific method, but Facebook Marketplace, every single morning, at least 4 to 6 new cars post on Marketplace. And that hasn't happened in forever. So if we use that as our metric, people selling stuff so they can make ends meet, then recession's looming. And a preferred share that pays that dividend in advance of the common share, that sounds really good. So where does that leave us for the week? Let me get to my spreadsheet and clear out my initial data. And I will explain this. All right, so this is our weighting spreadsheet. We come to the CF master, we put everything in alpha. So when we sort this, uh, triple asterisk is a buy alert, everything in negative is a discount. So break even would be like paying $1 for something that's worth $1. If you're buying it for 10 cents off, that's like paying 90 cents instead of $1. If you're paying something over $1, right? So that's not a discount, that's a premium. So that's like paying $1.06 instead of $1. So the buy alerts are discounts that are greater, that are double the historical discount for that single fund. And they're also greater than the 5-year discount average. 2 is based upon funds we own. So dollar cost average based on what they're worth. And then 1 is tracking for any number of reasons. So in order, so we go to sort by discount. And this is, I mean, this will be on a different video. But yeah, so you get semiconductor buy-in on the Taiwan market, an annual dividend. It pays once a year. Actually, no, I was wrong. It pays a little bit better than Apple. Apple pays 0.5%. This pays 1%. Not much. And yes, it has a very attractive discount, but this matters. Um, yeah, any rate. So we rank them by target. Current would be what we already own. So we own everything in blue. Purple is recommended. Oops, not down. Purple is recommended and green is tracking for any number of reasons. Why is that like that? It's always interesting. Targets. Always interesting. These cells do the strangest things week to week. It's the same thing from the last tab, but applied differently. So all the discounts are significant, so we can kind of factor that out. So we can look at overall yield. Our goal has been to target 9% and above yields. The exception to this is going to be this fund because, so I mean, our strategy is use the targets, right? So first and foremost, buy based on discount. The backup to that has been buy based on yield. But we would be foolish to ignore the top discount. This is currently selling for almost 50 cents on the dollar. So instead of buying it for $1, you're buying it for whatever, almost 50 cents. That's crazy. And it's that way because they flipped their portfolio. Uh, their prior portfolio was all bonds. And I can only assume, because I haven't seen the missive from the company, but I've seen the portfolio. They've changed to mostly real estate. It's like 60% common stock. And of that 60%, 54, 55% is real estate. And then on the private senior loan side, that's like 26%. And of that market, at least 13, 14% is real estate based. So a bond company who's been bonds for forever flipped their portfolio in advance of the Fed cutting rates. That's an interesting gamble, um, a very interesting strategy. But in doing so, like I get it, but that's just most funds don't do that. Uh, you kind of get the um, honestly, it reminds me of me, somebody who's willing to not be part of the herd and do their own thing, even though it just seems really crazy at the time. So their former portfolio was double the dividend, but they restructured. And in the current market, it's not yielding, it's not producing the same amount of money. So they cut the dividend in half. But I like their manager and they planned. So it's that we don't know what the Fed's going to do. If they cut rates, this portfolio will go up in value and that discount window will close and they will increase the dividend, which will also increase the share price and also close the discount. So at base level, they've maintained this dividend. If they go back to normal, that would be the dividend. So our strategy is buy on target, right? And it's discounted. Our second to that would be buy at 9% or above. And it doesn't meet that, although it's getting closer because the price keeps dropping. But if we bought any fund outside of our target, this would be it. Simply because it does have the greatest discount. And I like their manager and we already own it. So that being said, we can eliminate all this other stuff. There's some funds that are interesting. I mean, all the purple stuff is recommended for some reason or another. But using our strategy, I'm eliminating a lot. So we're looking at bonds if we can get it, oil, natural gas if we can get it. But we're also looking at data management, cloud tech, uh, cloud tech, real estate, convertibles, and preferred shares. So we can eliminate this. We're selling this fund as soon as we can. Well, not tomorrow, but the problem with selling these funds. So it's a automatic dividend reinvestment program, which means instead of paying us a dividend and leaving it there in cash, They pay us the cash and then take the money back and reinvest it for us into the company, which is a pain. And it says Aberdeen on the other one and not Aberdeen here. I just haven't changed it. Aberdeen merged with accounts and took over the management of the account. So when I sell these on Webull, I can sell whole shares, but I have to get them to sell the partial shares at whatever the going rate is for the day. Uh, and this will pay an automatic dividend reinvestment at the next distribution. So if I sold it tomorrow, I would still end up with the dividend whenever it got distributed. And we would acquire another 1.4 shares of this company. So it's frustrating to hold it that long because I would much rather just sell it. But after the next dividend and after the shares are allocated to our account, then I sell it and I sell all the whole shares and I get Webull to sell however many half share or partial shares there are. The same is true for this company. So knowing that we want to sell it, I really don't want to buy more of it. PDT is preferred shares, so is JRS. But the other side of our strategy is we've been going monthly. So if you can find a technology fund cheap, I mean, yeah, that's EOD, but they don't manage their fund well. KYN is an oil, natural gas, energy infrastructure fund. It is on target, but it's also higher than it's been in the last year. So it is still worthy to be on the triple asterisk list. It's also costing more because the cost is up. Um, Sadly, this fund that I like is also being looked at by Aberdeen. Um, and I don't like Aberdeen because we own, I don't like Aberdeen as a whole because they're closed-end funds, the windows of discount never really seem to change. They pay consistent to semi-consistent dividends that never really go up. And the discount window never really closes, which doesn't really matter in the long run if you're not selling. But everybody wants that increase of a return of investment. So if the discount window closed to break even and went higher, it would garner more interest with other people. Uh, but it's like we've sold a couple Aberdeen funds because not happy with their management, not happy with where they're allocated, not happy with the discount window never really closing, not happy with the dividend that never really changes. And lo and behold, they're partnering with more and more funds to expand their own reach, but also, from my opinion, kind of destroying other funds that I enjoy. Um, so that being said, we eliminate these. JRS gets eliminated because it's a quarterly payer. PDT is preferred shares. That's about half their portfolio. Uh, Calamos garners interest, but the consumer sector as a whole is way too volatile for me. Um, like it's interesting. I keep tabs on it, but right now with slowing economy, choppy Fed, interest rates high, it's too volatile for me. Um, Highland Fund, real estate, energies, utilities, bonds, that's an option. These two are sister funds. I know in hindsight, it sounds odd that we would own sister funds that pretty much do the same exact thing, but that's hindsight. And I want to say we bought this fund first, and then this was more attractive. More attractive. We bought that one, and I would honestly sell this one. Um, it's on the hit list, but we would sell that one. So we're just going to nix it from the list. And then BRW used to be just the floating rate senior loan company that loved the aggressive Fed, which we've kind of seen and haven't seen lately, but they've also started their own closed-end fund portfolio. They have a pretty extensive closed-end fund portfolio, which gives us access to a lot of funds that we may not necessarily own, which is good and bad because it gives us to a lot of funds that we wouldn't necessarily own that also don't meet our strategy. So it's kind of hit and miss. Um, so where does that leave us? Like if we're investing tomorrow, which I'll be honest, we're not. I'm I'm looking at not liquidating our portfolio, but I'm looking at selling 4 to 5 funds, and I'm strategizing the best way to do that. Um, what I did the last time was look at so like it. I like buying things in sets of 50, just like the math. That's about what's in our Webull account right now. So if I had to buy anything, the only thing we could pick up would be that because we could buy 50 of it outright and not have to do anything else. But if I had $1,000, or if I was dollar cost averaging funds and it was an automatic $500 every month, that kind of depends on your strategy. You've got the dividend cut and the portfolio restructure, mostly to real estate. You've got a heavy preferred share. You've got heavy convertibles and bonds. So a good way to buy into bonds, which is a pretty limited bond market at the moment, uh, or at least bonds that you can find on discount. You've got senior loans and more closed-end funds, and then you've got uh, kind of it's not a portfolio in a can, but it's a nice mix. It's bonds, utilities, energy, real estate, all really good. It really kind of depends on where you want to go. You could go based on discount. You could go based on current yield, right? You could go based on price. And I don't think any is an outright bad decision. PDT doesn't hit our standard on the 9% mark, but if it dropped during the week, like if it started, right, play with the numbers. So if it drops this week for whatever reason, it could stay on the list. There we go. But this doesn't normally stay on the list either because it's below the 9% mark currently. But that one more than PDT, this would push me to break our 9% rule uh, for the reasons I've already stated. If I have to follow the 9% rule and I'm buying only what we can afford, then I'm buying this. And if you were like buy whatever you want, well, I mean that's a blank slate. You can do whatever you want. So my advice would be I'm doing these videos for my benefit, but I'm also doing them for yours so that you can see the process, you can see what's involved, and you can see all my data and my reasonings and my ramblings and use it for your benefit because I don't want to invest your money for you. I want to help you better understand the market and learn more and help you take over the management of your own account. I have friends that are like, oh, yeah, I got a stock guide for that. And I'll be honest, we have a guy as well, but we're still trying to figure out what to do in that fund because he's got a very different investment strategy than we do. And my friends who have accounts are like, oh yeah, we have a guy for that. Well, what if you ran it? I don't know anything about that. It's intimidating. But if you learn a little bit, then you wouldn't be paying somebody else to manage your portfolio. And you learn if they're managing your portfolio in a manner that helps you or not. Um, you can manage your own portfolio And even if you don't, I won't say that. So even if you don't understand what you're doing, but you want to know what you're doing, my purpose in making these videos is to justify what I'm doing, but also help somebody else. And I'm doing all the research. I'm keeping all the data. I'm giving answers, uh, or hopefully giving answers or offering answers on why we're doing different things. And I'm sharing our actual self-managed portfolio. I mean, this is like everything but our account number and login information. This is what we're managing. And I mean, we're looking to sell this fund, this fund, this fund, because I don't, Aberdeen wants to buy that or manage this fund, but incorporate this fund into a fund we sold last year because of those same reasons. Bad management, bad strategy, inconsistent dividends, and the discount window never closed. It's currently, I looked yesterday. So the fund we sold last year is currently $1 more than it was. Whatever. That's not that much when you only own 50 shares. But the discount window hasn't changed. And if you look at the track record, discount window hasn't changed. It's kind of interesting. We're looking to sell this fund, which sounds bad, but it's that automatic dividend reinvestment. It's pay the dividend and then circle it right back into the company. Cash in hand dividend is the way to go. We're looking at selling this fund. See what else. And then we have this Aberdeen fund. I like this fund. The discount window does change in this fund. The dividend changes in this fund. But I think it's also just based on where it is. Aberdeen for the company is based in Britain. This fund centers around the countries that are on the Pacific Rim. So it's got investments in it's a global fund, but it's got investments in China and Taiwan and like that Indonesians like everything. Um, and it's primarily a bond fund. So it's not that we're completely averse to anything Aberdeen. It's just, yeah, insert like putting this in the same fund we ditched for the same reasons that already it's just not it's not a great mix for us. So we're looking to sell 4 or 5 funds that then we would recirculate, like we would not cash out those dividends and that in that money we would recirculate them back into our portfolio into targeted investments. And yeah, that's also why I make these videos, to kind of figure out where we're going in the long run. So I will ramble if I don't end it there. Uh, my top selections for the week, it's yes, those 4, but at the same time, it's not like there is one better option than another. It really just comes down to your strategy and what you're willing to follow and what you're willing to do. Are you going to look at discount only? Um, are you going to look at overall yield? Or are you going to look at when it pays? Or it doesn't have to hit every box. I mean, it's got to be uh, significant discount. It has to be 9% or greater, and it has to pay monthly. Or can one of those fluctuate? Uh, but I really I don't think there's a wrong answer out of any of those 4 for the week. Uh, and if I had to, if you forced me to buy a set, then I would buy the one set we could afford with what we have. And looking forward, I need to make a separate strategy video to review our portfolio and talk about why we want to sell some specific funds. So if you like this content, consider subscribing to my channel, hit the like button, head over to Facebook, find my group there called Navigate Your Finances. If you want to talk real estate, if you want to look at real estate outside the stock market and see the strategy we employed in buying our first rental or our first investment property, then all of that information is on Facebook. So as you face the week, gosh, there on the school side of things, there are 2 weeks till spring break, which is kind of the midpoint of the spring semester, which is flown by crazy fast. Regardless of where you are, regardless of where you want to be, you are the captain of your ship. You make the choices, and that's where the boat goes. The winds will push you one way or another, but so long as you know where you are, so long as you know where you want to go, and you have that point of focus, whether you can see it with your eyes or see it in your mind, that's where you're headed. Captain your ship. It will go where you lead it. So this is Daniel Young signing off. I will see y'all on another video. Bye-bye.